Hey everyone, welcome back to Be Rich. Today we're going to kick off a 5-day adventure into different American and European and Japanese stocks. Sector wise, I've broken them down. I did ask over the weekend for you guys to let me know the companies you'd like me to talk about, and you guys gave me around 36 to 40 companies to look at. So I kind of like broke them into sections or sectors or how we should approach the market. And today's, of course, if you've been following me on Instagram, would see day one today. I want to talk about safe havens and defensive stocks and the companies which fall into this. Yes, I'm not dived into each company wise because if I do each company as a separate video, I'll be doing the entire month and that will get boring for you and me. So I've kind of clubbed it together. So how to take this as an approach as an investor and my advice to you, and that's the idea. So we will first talk about staples and REITs and gold, which fall into the safe haven defensive sector, and why currently this should be on the top of your mind, and how to take this approach if you are an NRI, and how to take this approach if you're an Indian investor looking globally is the idea behind this video. And I'll of course get into the companies and tell you if these companies where they are in terms of valuation, in terms of discounted cash flow and intrinsic value, and I leave it up to you as a viewer that you should do further investigation and to see if it fits into your goals and see if it aligns with what you need. Because I cannot tell you on a video like this that I recommend you do this or I recommend you do that without any idea where you are and what your goals are. So that is why please never follow advice from any platform, whatever platform it is, whomsoever it is, just based on what they're saying. Get inspired by it, but then deep dive and see if it matches what you need. And that is paramount to all of this effort you're doing. Anyway, that said, today, of course, safe havens, first thing which we can talk about, the central pillar to any defensive portfolio build is gold. Gold is a central pillar which everything comes around. Staples, rental income companies, all these come around gold. Gold is the pillar that holds up your defensive portfolio. And why do we look at gold? Because gold, staple companies and rental companies are not like your growth stocks like Nvidia, which would not skyrocket overnight. These have a very stable growth over a long period of time. But while everything else is bleeding, they tend to hold on to their capital and hold on to that price point quite well. Their correction seems far smaller in weightage compared to the other companies when things go bad. So the way I would say you should think of it is like carrying an umbrella. When you think it's going to rain and it looks cloudy outside, it's better to carry an umbrella. Then you're thankful that you did when the downpour does come. But, sometimes it doesn't rain. That does happen. But looking at the weather today, that's talking allegorically about the market, the way the markets are, what Trump is doing, and him saying August, he's giving more time till August before the tariffs come back, haunting everybody. The market is turned negative again. The Japanese market opened negative. Indian market, I don't know where it is currently as I'm recording, but there are stocks which are correcting. And even the Dow future, where most our channel's attention is negative. Okay, gold first. Let's talk about gold. In the US, the biggest gold ETF is GLD, the SPDR gold shares. Then you have the IAU, the iShares Gold Trust. Then you have the AAA, the AAAU, that's the Perth Mint Physical Gold ETF. Most of these are all backed by physical gold and they simply track gold prices. There's nothing complicated in them, and you can take your pick, whichever gold you want, and basically there's no secret sauce in this. There is no churning of the portfolio as in other funds and other ETFs. This is a very simple, straightforward thing. Buying an electronic version of gold in the US. So why this is universal hedge? Especially when the dollar is weakening, like I've been talking about, the dollar index sitting at 96 when I'm recording this video. The markets, when they panic, this is a great thing to be in your portfolio, even in the US. Not only do we talk about it in India, in a developing market, but we're also talking about it in the developed countries. Gold is still a great hedge to hold on. You've heard people like Peter Schiff now talking about gold and the importance of gold. And most importantly, gold always tends to be steady when markets are correcting. Not steady, even tends to grow, depending on how bad the pain is. For NRIs, I would say in looking at investments in US and Europe, you should definitely have gold in your bucket. And the cleanest and the easiest way to own this gold in the US and Europe is to look at gold ETF. And that is because there is no vault storage and purity problems. especially when you're sitting outside and you do not know your local gold shop and you do not know where to buy the gold. This way it's all covered and it's easy, and you can look at gold ETF as an option. Next on the list, gold, like I said, is a central pillar. What leans on gold is, of course, the REITs, that is a Real Estate Investment Trust. Okay, we have them in US, we have them in Europe, we have them in Japan too, and of course we have them in India. The big part of this is it is like real estate mutual fund. For those of you who do not know what REITs are, imagine what is a mutual fund. It's a group of stocks you're not able to buy, but by owning the mutual fund unit, you are invested in these companies, like the Nifty 50 passive or the S&P 500. Same way, you don't want the hassle of buying a property, maintaining the property, finding a person to rent it to, and all those hassles, taxation. So what happens is there are companies which take their money, they take care of everything for the property, everything, and they collect the rent, and then after all expenses are done, they divvy out that to investors who have invested in the company, the shares. So that is what it basically is. So that is the idea behind this. So what you do is you get exposure to real estate, and you can choose your real estate which you want, be it commercial, be it warehouses, logistics, data centers. There are all kinds of varieties in the US. You can pick the one which you feel is right, which is the right fit for your mindset or what is in your wheel warehouse and your moat, what you understand, your circle of competence, as they say, and you can look at it. Why is this defensive, you may be wondering. You might be saying, the market's turned bad. Usually real estate, does badly, but people still need, data centers. People still need businesses, still need spaces. Medical facilities still are needed. So certain, real estate is always required, no matter what is happening to the economy, wider economy. So this you remember. Of course, other places will hurt, like shopping malls. Those may go through severe downturn. So that is why it's important to understand the real estate, what you're taking exposure to, and invest according to that. And do remember, these also correct massively if the market collapses. For example, what happened in Japan in the 90s, or what happened in the housing crisis in the US. During that time, broadly the whole market is collapsing, so everything is hurting. So even there, this hurts, and it hurts a bit. It's not like gold. That's why gold is a pillar, and this is not like gold. Pain can come here too. Remember this. And what are the companies which are there in the US which are this? Some of them which I looked at, which I thought I could share with you. One is called Realty Income. They're often called the monthly dividend company because they pay on a monthly basis. They have priced around at $57, and I would say their intrinsic value is around 72. They're around 20% under. Then you have someone called Simon Property Group, which are mainly into shopping malls. They're priced around $166, and they're around 17% undervalued. Their intrinsic value is around 200. Then you have Prologis, which is a logistic warehouse company, and they're priced around at $108, and they are also 16% undervalued. They should be, intrinsic value puts them around at 128. I've not dived into the history of the last 5 years to see if it's attractive or not at these price points, because there's lots I need to get into the video. So I'm not diving into each individual company. I'm just giving you a broad stroke to get your appetite wet, as they say. If you're really interested in this or the companies I mentioned, deep dive, read about it. Find out where are their warehouses or where are their logistics centers, how long have they been there, study the cash flows, then see the dividend payouts, the dividend yield, see the debt. Have they borrowed a lot of money to do these investments? That kind of analysis is of course required before you decide to jump into real estate companies. Keep that in mind. In Europe, we have someone known as Uniball Rodham Westfield. They are into shopping centers, and even in UK, you have Segro, which is into logistics and industrial areas. So this is basically to say these kinds of companies exist throughout the world. Most markets have them. Even in India, they're there. I'm not getting into the Indian ones because this channel is looking at American and European and Japanese. So keep this in mind. Anand and me are not big fans of these. We do not like investing in real estate. We usually tend to avoid it. So that is why we usually do not talk about this, as a great strategy. But in a defensive portfolio, like I said, if you require it, if it is required and you need to align it, please do look at it. If you've been in the market for a very long time and you're well diversified and you know what you're doing, then maybe you can think about it the way Anand does. But if you don't know anything and you're new to this, it is not a bad thing to have in your portfolio if you have done your due diligence. Moving on, staples. This is a classic defensive sector which a lot of people look at, and you should also definitely look at and have it in your portfolio if you're looking at it as a defensive portfolio when the markets turn bad. Why? Because everyone, no matter what the economic condition is, we being human beings, we need to have food, we need to have shampoo, soap, we need to use all kinds of products on a daily basis, regardless of how the market conditions are. You still need baby formula, you still need diapers. So keep this in mind. That is why staples are usually considered as a defensive stock. But like I said, they're not growth companies. They're not going to be like your Nvidia or anything that will skyrocket overnight and go somewhere through the roof. These tend to be slow and steady wins the race kind of companies. In this, we have, of course, the famous one is General Mills. A lot of you asked me about that. It's traded in the US as GIS, and they are trading at $54 currently. And I would say their intrinsic value should be around 88, and that would put them around 40% undervalued. Kraft Heinz, I did a full video on that about how Warren Buffett's company has stepped down from the board, but they're still holding some shares. Maybe they're looking to liquidate and exit the company. It's one of his long-term holding companies. He's had it for a very long time. So follow that news and see where that is. But as far as the company is concerned, it is going through a bit of pain, and that is why it is valued at $26 a piece now. Intrinsic value, which puts it around $60, which puts them at almost 60% undervalued. But like I said, they're going through a metamorphosis right now. There's a lot of pain in the company. All these numbers are always looking back. Looking forward is very difficult to predict in any market condition. So, like I said, please do your due diligence before you dive into this. In Canada, for example, we have a company called Dollarama, which is a discount retail, and they're trading at around 190 Canadian dollars. And their intrinsic value, I would say, is around 133 Canadian dollars, and they're around 30% overvalued at this current price point. Then you have, of course, Alimentation Couche-Tard, which is like a 7-Eleven gas station outlet. They're spread across, and they're also a Canadian company. They're around 69 Canadian dollars, and their intrinsic value should be around 96. They're around 30% undervalued. Like I said, these are broad strokes I'm giving you to feel inspired to do further research and understand if you need to get into a defensive portfolio. This is the way you should approach. Now, talking about all this is great. Now, what do Indian investors need to do if we are sitting abroad? It's a main question, which is a valid point and what you should be thinking about and wondering about. If you are outside India and you are looking at Canadian, European, Japanese market, and you need to get a defensive portfolio, remember first, put gold as your central pillar in your portfolio. How much percentage of gold, that you will have to figure out based on your risk and your situation and where you're going and your goals. Me telling you 5%, 20%, 30% is meaningless if it doesn't align with what you need to do. So please analyze that. But gold is a must, and what your portfolio should be built around is gold. And like I said, real estate rental income companies, trusts are great because they offer you steady income, especially when markets are looking negative. And of course, staples also give you dividends, which is great for your cash flow, which is also another reason you should be looking at them. But the percentage in the companies which you should be specifically look at, that you need to study a little bit more. I hope I gave you some inspiration and pointed you in some direction on how you should look at. Tomorrow, I'm going to talk about big tech and of course growth companies, which is the other side of the barbell. This is known as the barbell strategy, where you have certain, if you know a classic barbell, that is, you have the weights on either end and you hold in the center. One side you have all your defensive stocks and your defensive portfolio, which holds you up. The other side is your growth and your big tech, which will also offer you growth. So depending on how the market seesaws, your barbell can move around. But basically, overall, you tend to get a strong portfolio. So this is the idea behind this. So tomorrow I'll talk about big tech and I'll talk about growth stocks and offer you some insight there. And I'll of course hit upon the companies you've spoken about in your list, and I'll tell you where their intrinsic value is currently. And like I said, talk about it in broad strokes so you know what to do. So stay invested, stay patient, and see you tomorrow. Thank you for watching Be Rich today. Bye.